Hi guys, this is Andrew from Algonel, the scientific trading innovator. In this video, I'm going to show you some risk analysis ideas. So suppose you have some trading ideas. In this example, this is our product. You can see here some assets and the underlying probabilities for those assets to go up or down within the couple of next weeks. So let's suppose we actually select one asset and we want to be sure that we are willing to trade this one. So we begin our analysis with options chain. We believe that assets that are very liquid have a lot of options. Let's take a look on Amazon. You can see that Amazon has a lot of options, way above the current traded price and below the traded price. So this is very important. The next step is something more sophisticated, which is about modern portfolio theory and the Markowitz mean variance optimization. So we start with just getting some historical data, and then we take a look on some historical performance of our suggested trading signals. So we can see in this examples of the cumulative return for those assets is, very positive. We can see that those assets were performing very well. On the other hand, here we can see some other suggestions of trading signals. We can see, that sometimes, the performance was poor. Those are some bearish trading signals, and we can see that, and this is what we are looking for, the performance was low, meaning those assets are constantly going down. So, this is good for bearish signals. Let's then take a look on some returns per day. We can see that in this example, this combination of assets, we can see that, the average return per day is something around 5%, okay? And sometimes it, goes minus 5%, but sometimes there are spikes, of over than 20%. So this is very important. In this example, you can see that, it's even wider because, the average is around 10%. So this one is way riskier. And this one is for the bearish signals. And once again, we can see that the average, the mean is around 10%. Well, this is another aspect. Let's go further. So mean variance optimization is all about the efficient frontier. I believe you heard about it, but let's make it simple. So think about making a lot of portfolios. Think about having thousands of trading accounts, but with different values and counts for each and every asset. So suppose you have 100 stocks of asset A and then 100 stocks of asset B. Those weights could be different. They could be, say, 50 of asset A and then 150 of asset B. So this is basically what happens here. This is a lot of combinations of different number of stocks for the same assets in different portfolios. When this stuff goes up, it's good. It means that, in average, usually you're performing very well. And here you can see the standard deviation of your returns, which is basically risk. So this one is for those trading assets. And for the bullish trading signals, once again, it goes up slightly, but it will take you more time because, it's riskier. On the other hand, for the bearish signal, we can see that, it's a straight line. It doesn't go up. So, once again, those are bearish signal. It's good for our analysis. Eventually, you can add the efficient frontier, which is just a tangent line that touches the optimal portfolios that have the optimal weight and show the best combinations of assets. So another aspect is some volatility analysis and, max drawdown. Think about it. So you're looking for assets that were performing very well, but, what about the max drawdown? So let's take a look on a couple of assets. So Pfizer, we can see that for the past 3 years, the return on capital for this asset was, almost 100%. And, the max drawdown was not even 14%. So this asset, we think, is a good one to invest in. So, on the other hand, we can see that sometimes assets have a very high volatility and lower returns. Let's take, for instance, this one. This one is a bullish trading signal. We can see that this asset, the AMX, was performing for the past 3 years poorly because, eventually you would lose money. You would have 30% return on capital. But recently we see that this asset is going up, and we think it's about to go up. But once again, the max drawdown, the historical max drawdown, is around 60%. So this one is a bit risky. About the bearish trading signals, we can see here that ABX is, so far, the max drawdown was more than 70%. And so far, you would lose money. But then again, this is a bearish signal. So if you would sell short this one here, you would actually have made 40% return on capital. Another aspect is, the value at risk. Um, Value is at risk is basically trying to bound uh, the percentage, the maximal percentage of loss on your um, on your investment. So we are looking for assets that have less than the average, say 5% value at risk, and those assets that are actually higher than that, we think they are risky. So for instance, in this example, the IRCP, we think it's risky. Okay. Another aspect, we think that INS is, risky. On the other hand, we think that, well, VNTV, Ventive, we think that this asset is good for investment. And same goes for the bearish signals, and eventually alpha and beta. So think about it. We know that we usually benchmark our performance with some ETF or some index. Usually is the SPY, right? Uh, in this example, we can see that those trading signals on average have alpha, which is higher than zero, which means on average we make more money with those signals than the S&P 500. And the beta, usually it's bounded around one, which means, on average we make twice, or at least we are risky as the S&P 500. So those are some ideas for your risk analysis the next time you actually are incorporating some trading ideas, or in general trading. So thank you, and please visit our website and see our products. Thank you, and good luck.